Hi, ladies and gentlemen. This is July 12th's weekend stock talk. I posted a video yesterday, but wanted to give an update today as well going into the weekend. And I will respond personally to every single comment that was made in my last video. So you can hear it out here. But for what it's worth, let's talk about S&P 500 today. Another new high. So what you're looking at right now is the S&P 500 on a 5-year time span, because I think it's important for everyone to realize what's going on here and whether we should be fearful of the move higher towards all-time highs. And this plays into market psychology here. And we explained portion of it last time around, in which we talked about how price has not moved too far away for 1.5 years, and right now we're breaking to all-time highs. Is that bullish or bearish? And I think that is quite bullish. We have established in the past weeks, months, days prior that this is a bull market, right? We established this was a bull market down here. We established a bull market up here, and it's no different. What we can see here is the bull market continuation playing out. So if you were to expect continuation after 1.5 years of major consolidation, think about how much push the markets can move higher from here as we move on forward. Just think about it. A lot of people right now, I think, are fearful of another major drop, and that again is the fuel of the fear, is the fuel for the S&P 500 to move higher, further towards all-time highs. Why is that? Well, let's talk a little bit about this. Remember how we talked about this is the first initial scare in which no one expects this scare to come. We make a slightly new high, everyone gets exuberant chasing this high, and then we got a major collapse. Then we got this high, and we got a repeat of this scenario here. And for people who were not aware of this, now we're making new highs. Everyone is so scared of these marginal new highs that no one wants to participate in this rally. But people are fearful that, okay, yes, this is a breakout, but we can collapse at any time, so let's not participate. I'm not saying that you should participate, but I just want you to see the mindset. It's occurred once, big drop, twice, drop. This time, we don't have any signs of us dropping, so until we can get a sign of us dropping first, we can't say that the bears are even in short-term control. And certainly in the long term, we can't say that this is a bear market. The argument has to go towards that this is a massive consolidation, similar to what we had in 15-16, in which we consolidated and then we had significant gains after a period of a long consolidation period. Here, again, we have a long consolidation period resulting in the first move higher. Can we get a pullback of 5%? Can we even have a larger pullback of 5 to 10%? The answer is yes, but the question is, where is it going to come from, right? But for now, if you can imagine mustering the energy for 1.5 years, that energy is getting pushed to the upside, so look for more upside for the S&P 500. That would not be surprising in any case, I think. As we continue to push higher. All right, so now let's take a look at one of the opposite indices or the indicators, which is TVIX. So TVIX tracks volatility, as you all know. Look at TVIX, look at volatility, and what have we been establishing in the past? This chart pattern on the daily time frame continues to make a lower low and a lower high. This is confirmed by broad markets making a higher high, breaking all-time highs. Expect volatility to continue to decline until we see otherwise. And this pattern should continue to decline, sure, we can get a small move higher, but we get rejections off the 20 period or near the 20 period moving average. We expect this to be sustained as we move forward until we can see otherwise. So with that said, this is likely to push lower. Broad markets are likely to push higher. With crude oil, we've established the fact that crude oil is a little bit elevated. So again, right now, what it's more enticing to me right now is the breakout on broad markets. Less enticing are some commodities, because commodities, if you look at this chart pattern, you can't tell me that it's been consolidating for 1.5 years. Because what we can say here is up move, we came down, we got a little bit of some compression, right? We have a lower high, we have a higher low, so there's a little bit of a compression going on right now for crude oil. So short term, looking for a potential little bit more downside, and then if we take a look at the reaction off the moving averages around $58, if we can hold that support level, that would be bullish for crude oil. Look for some more potential upside later on, but this chart pattern is not as enticing as some of the chart patterns for broad markets. Natural gas. So here is natural gas. We've seen definitive rejections off the 50 period moving average, and today we closed over the 50 period moving average. So that is pretty bullish for natural gas, but we know that here is a resistance that is close by, 2.57. We also realize that we're going into the weekend with a small push over the 50. So for what it's worth, this is a more confusing technical pattern, right? This is a confusing technical pattern because we know that going into a weekend, this can actually reverse and push back down as well, but at the same time, we wouldn't be surprised if it does push towards 2.571. So because this is confusing and can go both ways, there's less of a trade, in my opinion, for natural gas. For gold futures, this analysis has not changed as gold has consolidated towards the right for a likely scenario of more upside potential. Right now, we don't see the upside potential playing through, but this can push to the upside in the next few weeks. So let's tackle a couple of your comments. We'll start with the comment made by Crisp Critter. So he or she says, Kevin, we have a triple negative divergence on the S&P with the market overbought. This never ends well, maybe a few points higher towards ES 3010 and 3025. The risk reward ratio is not attractive here. Big money isn't putting money to work here. So with big money in fund managers, you have to think, have they been right in the past in terms of fund managers? Have they gotten right in terms of the bottom here? And have they been correct getting to the top here? You have to ask yourself, have they been right so far? And if they haven't, why haven't they? Or should we follow their lead? So you have to think about that first of all. In terms of the negative divergence, I can make the instance of negative divergence all over the place. Negative divergences occur all over the place. How reliable have they been? Because if markets continuing pushing higher, maybe you can have more negative divergences. So you have to look at, objectively speaking, where the price is. If you're waiting, you might have to wait a long time before that next major pullback. And that's just the name of the game here. You talk about the market being overbought. You know, when you're talking about overbought, do you mean this is overbought? Do you mean this is overbought? Do you mean this is overbought? To what aspect do you mean it is overbought? Because what I see is a multi-month, several 1.5 years of consolidation in the first breakout. And I would say that it is very underbought right now, especially if you said big money isn't putting their money to work here. If big money isn't putting their money here, when they do put in the money, where is the S&P 500 going to go? It's interesting, right? So just giving you that side of the scenario that, we can have divergences all over the place, but is that the best way to analyze the markets? I think price speaks to itself. All right, so let's talk about Steve. BMY IRM, please, and thank you. So Kevin, I'm always excited to see a new video from you. Thank you for your time and efforts. Yeah, if you enjoy these videos, please hit that thumbs up button. If you enjoyed it, if you find it helpful, my opinion, of course, on broad markets, you're coming here for some opinion, you form your own opinion, and you make your best choice. That's always the case, and that goes for the same for the members in my group. I have my own opinions, but you make your own opinions and see how well you get things right or wrong, and you just learn from them. So yeah, so what is BMY? So we'll tackle one of your tickers, and then if you can, please repost that ticker later on. So BMY is Bristol Myers Squibb. So if you look at this chart, this is not the best chart in the world in terms of, I think, moving towards the upside. If you just look at this chart, all four of our major moving averages are curving lower. You can see the 20, the 50, the 150, the 200 continues to be pushing lower. This chart pattern continues to make a lower high and a lower low. So it's not something that I would be chasing in terms of an upside potential. I can almost even say that this has been a struggle for this ticker to move to the upside in the past few years, right? And that the upside is not worth, in my opinion, the risk. Your support level has to be down here around 44.63. Obviously, the break of this support level today was not something you want to see. So that's that. It's on a downtrend, and I can't see any major reversal just yet. And that's if you're talking about risk reward not being too favorable, I mean, this is one in terms of risk reward not being too favorable in terms of going long. So that is BMY. Moviegoer, what are your thoughts about Amazon? Valuable insights. Thank you. So Amazon, you look at this chart, it's a very solid chart. However, you have to place emphasis that we are at near the near-term resistance, right? Around 2030. So you just have to keep that in mind. 2030, we're at resistance. We have earnings coming up. But if you also think about Amazon, think about it like this, okay? Think about it like this. If this is the start of the next bull market, a multi-month, maybe even multi-year bullish market, we expect Amazon to pop 2030. Okay? And they might do that on earnings. So, in that case, while we are at resistance, we are showing an uptrend. What is an uptrend? It's obviously something that's like this, higher highs, higher lows. We have a period of consolidation, right? And now we're pushing higher again. So while Amazon is at resistance, we have earnings coming up. You got to monitor your risk reward. But overall, this is a solid chart pattern. Would not be surprised for this one to move over 2050 and all-time highs as we move forward. This is a good chart pattern. Thank you. And then finally, K9, can we review McDonald's and Pepsi or Pepsi? Let's take a look at your first ticker, which is McDonald's. Very nice move. So McDonald's, what we can see here is big up move, a year-long consolidation, and now we're in the middle of the up move. This is on a higher high. As you can see, this does not look like it wants to stop. And so we can see that while this is slightly overextended over the 20 period moving average, this is on an uptrend. So this is a good chart pattern. Once again, look for this chart pattern to continue, I think, at least in the near term. So McDonald's looks great as it you can see yesterday made a new all-time high. Does that look like a reversal to you? The answer is no. And then Coolio, the do not fight the trend. Cannot agree with this more. Don't fight this trend when the trend is breaking out or just starting to break out, or so that's it. Thank you everyone for watching this video. Hopefully you learned something from this one. Check out the course. The link is in the description box below. And Yeah, if you have anything special you want to add, feel free to comment down there. I like to answer everyone's questions and or comments, give our alternating viewpoints. Someone says that we have divergences overbought. I'm saying that the market's just started to push to the upside. You have two varying different views. So there you go. Thank you, everyone. Have a nice day.